Share can be issued in three ways: share at a par, share at a premium, share at a discount. Investment is the employment of funds with the aim of getting return on it. An investment is a purchase of goods that are not concerned today but are used in a future creative wealth. What is a share? Share is a part of share capital or the capital of a joint stock company called share capital. Hello my dear students, I am Dr. B.S. Subramanya, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Aid College, a Temple of Excellence, MYSURU. In this session, I am going to explain what is security analysis and portfolio management belongs to 6th semester Unit 1, Session 1 in favor of Introduction to Management. So I am going to explain what do you mean by management, how the investment will take place, how different ways it can be invested. We'll go with the detail. Define investment, explain the alternative of investment. This is for 15 marks. They will ask for 15 marks. Investment is the employment of funds with the aim of getting return on it. Whatever the excess fund we have got, whatever the amount we have got, instead of putting what called keeping ourselves, we are investing the fund. Investment is the employment of fund with the aim of getting return on it. In general terms, investment means the use of money, hope to making more in finance. Investment means the purchase of financial product or other item of value with an expectation of favorable future return. So we have expecting the favorable return by putting the excess money in the investment. The funds which have got invested, we are expecting the more favorable. It may be interest or whatever be. I am going to explain. So the funds which are available has been invested in such a way that so that a favorable return should become. Then an investment is a purchase of goods that are not concerned today but are used in a future creative wealth. This is most important. The future creative health depends upon the investment we made. An investment is a commitment fund making the expectation of some positive rate of return. Example, equity share, preference shares, debentures, and alternative investment is a financial asset. We want to put the amount in the form of equity share, in the form of preference share, in the form of debenture. The return may be at the end of the year, but definite returns are there. So money has been put on equity share, preference share, and debenture. So to have that, it is nothing but a financial asset. An alternative investment is a financial asset that does not fall into one of the conventional investment categories. Conventional categories include stock, bonds, and cash. Most alternative investment assets are held by institutional investors or accredited high net worth individual because of their complex nature, lack of regulation, and degree of risk. Alternative investment includes private equity or venture capital, hedging funds, managed future, art and antiques, commodities, and derivative contract. Real estate is also often classified as an alternative investment. So you have got alternative investment in different ways, in different circles. It has been invested in such a way that so that we can earn more return in their alternative investment is considered. It may be different commodities, different ways, so that we can earn more interest. Share is a part of share capital. Share means a share in the share capital of the company in the business organization. The share which are used by companies are two types. One is equity share, another is the preference share. So there are two types of share. One is called equity share as the permission, another is the preference share. Equity shareholders are permanent shareholders, whereas preference shareholders are temporary shareholder. Preference share money will be paid after a stipulated time, whereas equity share money will not be paid till the company liquidate. We will invest in such a way that so that we can get a very good favorable return. The shares which are used by the company are two types. One is equity share and is a preference share. The share capital of the company is divided in number of equal parts. Each such part is known as a, what is a share? Share is a part of share capital or the capital of a joint stock company called share capital. It has been divided into number of units. Each unit is called a share. A public limited company has to complete 3 stages. First, registration. This is important. Second is the raising capital. And the third is the commencement of business. These are the 3 important what's called stages are there. One is registration. Second, raising the capital. Third is the commencement event. A public limited company issue share to the public for raising capital. This is important. We will issue the share to the public to raising capital. The first public issue is known as initial public offering, IPO. The share can be issued at par, at a premium or a discount. 100 rupees share issued rupees 100 is called share at a par. 100 rupees share issued at rupees 120 is share at a premium. 100 rupees share issued at rupees 90 is share at a discount. Share can be issued in 3 ways: share at a par, share at a premium, share at a discount. Share is a part of share capital or the capital of the joint stock company has been divided into number of parts. Each part is a called. There are 2 types of share. One is called equity share and is called a preference share. Equity shareholders are permanent shareholder, whereas preference shareholders are temporary shareholder. Their money will be paid back after a stipulated time of 2 years or 3 years are concerned. Then debenture. A debenture is a document issued by a company as an evidence of debt. It is a certificate issued by a company under its sale, acknowledging the debt due by its holder. The term of debenture include debenture stock, bonds, and any other security issued by a company. The Companies Act provides that a company can raise loan from the public by issuing of debenture. The debenture holders becomes the creditors of the company. A debenture is nothing but an acknowledgement of debt. Almost it is a secure creditor will take the loan from the other company or from the public so that it will pay back it is called debenture holder and will pay back the man after a stipulated time. So they are called creditors of company, which is called secured creditors. Debentures are called secured creditors. Bonds. Bonds refers to debt instrument bearing an interest on maturity. In simple terms, organization may borrow funds by issuing the debt security named bonds having a maturity period more than 1 year and pay specific rate of interest, coupon rate on the principal amount to the holder. Bonds have a maturity period of more than 1 year, which differentiate it from the other debt security like commercial paper, treasury bills, and other money market instruments. So bonds is another type of what's called debt. So we'll pay back the debt after 1 year. It may be bonds or it may be funds, so that the money will be paid back after 1 year. So then we will go back to public deposit. The Company Act provides that company can accept deposits directly from the public. So they can ask the public to pay the amount, will pay back the amount. This mode of raising fund has become the popular in 1990 because the bank credit is costlier. When the bank credit become costlier, we'll go with the help of the public to ask the deposit so that we can utilize for 1 year. As per the Provisional Companies Act, a company cannot accept deposit for a period less than 6 months. This is important. And not more than 36 months. So it should be not less than 6 months or not more than 36 months in order to meet the what's called temporary financial need. So if you want to make the temporary financially, instead of going bank, we'll take the help of the public deposit, borrow the money, not less than 6 months, but not more than 36 months, utilize such deposit, particularly among the middle class investor. This is very popular in the middle class investors circle. Almost all companies collect crores of rupees through such deposit. They will collect the source deposit. The maximum number of months is 36 months, not less than 6 months, not more than 36 months. Bank deposit. Investment of surplus money in bank deposit is quite popular among the investor. So now whatever the excess money comes, we deposit in a bank. It may particularly among the salaried people, bank, cooperatives, and commercial collected working capital for their business through deposit is called bank deposit. Especially for middle class people, we deposit the money because money is very much safe. We'll put the money in the bank deposit, earn the interest. The deposits are given by the customer for specific period, and the bank pays interest on them. In India, all types of bank accept deposit by offering interest. The deposit can be accepted from individual, institutions, and even business enterprise. The business and profitability of bank depends upon deposit collected. For depositing money in the bank, an investor or depositor has to open an account in them. A depositor has to open a bank account. Every month they will get the interest. So especially for middle class people, bank plays a very important role because it is a guaranteed run by the government so that we can get back our money once in a month, once in 3 months, once in a year. So it has got, we say that fixed deposit, SP account is there, current account is there, so that we can utilize the bank in such a way that we can get the interest regularly and also the interest is definite. Then post office savings account. Post office operate a finance institution. It collects small saving of the people through savings bank accounts facility. In addition, time deposit and government loan are also collected through post offices. Certain government securities such as Kisan Vikas Patras, then National Savings Certificate, NSC, etc. are sold through post offices. New such schemes are regularly introduced by the Postal Department in order to collect the savings of people. This includes recurring deposit, monthly income scheme, PPF, etc. Now, just like a banking also, a post office plays an important role. So some people who are interested in bank, not interested in bank, can deposit in the post office also. So they will also give same facilities are there. But here the rate of interest may change. Then public provident fund, PPF is one attractive tax sheltered investment scheme. So tax benefit is there, and salaried, it is even useful to business and higher income earning people. It may help the salary people also, higher earning people also. The PPF scheme is very popular among the marginal income taxpayer. The scheme was introduced in 1969. So definitely who introduced the public provident fund, so tax benefit may be enjoyed. Then money market instrument. Money market is a center in which financial institutions join together for the purpose of dealing in financial or monetary asset. So it is one of the important purpose, money market. So invest the money in a monetary asset, financial asset, which may be short term. The short term means a period up to 1 year, and the term near substitute the money denotes the any financial asset which may quickly converted into money. So here we can easily convert it into money with a minimum transaction cost. Thus, money market is a market for short-term financial instrument, maturity period of which is less than 1 year. Mutual fund. Mutual fund is a financial intermediary which collects savings of the people for secure and profitable investment. Is another investment scheme so that it can provide the financial help to the institution or individual. The main function of the mutual fund is to mobilize the savings of the general public. It mobilizes the general public in what's called money in such a way that so that they can invest the money in such a way that they can get back their interest in once in a month. Investment them in stock market security, the entire income of the mutual fund is distributed among the investor in the proportion of their investment. Expenses for managing the fund are charged to the fund like mutual funds in India are registered as a trust under the Indian Trust Act. The trustees are appointed and they look after the management of the trust. Here, a management trust will be appointed. Whatever money you deposited, that will be put in somewhere. Once in a month, they will pay the interest. A mutual fund formed by the company together of a number of investors who hand over their surplus fund to a professional organization to manage their fund. So they are professional experts are there, especially finance is concerned. Whatever the funds are there, we can invest, they can reinvest and get back the money with higher rate of interest. Then life insurance policies. Nothing is more important to a person than the feeling that their family is financially secure. So this all important. Life insurance is a contract whereby the insurers, in consideration of a premium paid either in a lump sum or in a periodical installment, undertake to pay an annuity of a certain sum of money either on the death of the insured or on the expiry of a certain number of years, whichever is earlier. Here, you make your life insurance company, you deposit the money in insurance company in a longer period. The condition is either the money will be paid to you. By chance, if the death is there, it will go to either the death of a person or the expiry date, whichever is earlier. So, it's a guarantee amount payable by the insurance company to the insurer. By chance, if anything happens to insurer, then the money goes to the nominee of the insurer. So, either the expiry period or death, whichever is earlier. Investment in real estate. Investment real estate includes properties like building, industrial land, plantation, farmhouses, agricultural land, near cities and flats or houses. So the amount invested either in the building or industrial land or the plantation. So attention of a financial investment, it is an attractive as well as a profitable investment avenues today. A residential building represent the most attractive real estate property for majority of investors. The price of the real estates are increased day by day. You know that if you purchase a building about 10 years back for rupees 10 lakh rupees, today it is valuing more than crores of rupees are there. So that the investment made on the building definitely goes on rising day by day because they are changing. So the most important investment today, put the money on the real estate, on the building, on the land, so that we can get back higher return. The land is limited on the earth, but this is important. The land is limited on the earth, but population has been increasing as the demand increases, but the supply of land is limited. Land is limited and the population is more. Definitely, we can get back higher rate of return. So we move on to investment in gold and silver. Gold and silver are the precious object. Everybody likes gold and hence require gold or silver. So investment can be made. Either gold or silver is one of the best investment we can find in the society. These two precious metals are used for making ornament and also for investment surplus fund over a longer period. So once you invest whatever the money invested in the what's called either in a gold or a silver is definitely fetched for a longer period is considered. So everybody likes to make either gold or silver. If they put the money on the gold or silver for a longer period, definitely a good return will be expected. Then derivative instrument. A derivative is a product whose value is derived from the value of underlying the weight index or reference rate. The underlying asset can be an equity, forex, commodity, any other asset. A derivative security can be defined as a security whose value depends upon the values of underlying the variables. Very often, the variables underlying derivative security are the price of the traded security. So we can put the money in the derivative security. In the long term, definitely we can accept more return from them. Commodity. A commodity may be defined as a product or material or any physical substance like food grain, processed products, and agro-based products. Metals are currency which investor can trade the commodity. One of the characteristics of commodity is that its price is determined as a function of its market as a whole. Well established physical commodities are actually traded spot and derivative commodities are market. So the amount which you have got more fund, we can invest the money on like food grain process because it's one of the important demand we have got food grain. Better to invest this fund so that we can get back the good return. Hope you understand. We have gone through the how the investment can be invested in different sources, how much you can get back the investment return. So this is one of the important chapter from the BBA 6th semester BBA is concerned. Definitely a question will be asked for 15 marks. Hope you understand. We'll meet in the next session in the unit 2 with a problem. Till then, goodbye. Meet in the next session.